Welcome back to the podcast, Generate Income by Selling Options. In previous episodes, we talked about theta decay. Let's now dive into this topic in more detail as it is an important Greek to know and understand when trading options, especially when writing options. Let's bring in our hosts to dive into theta decay. And as a reminder, please subscribe to this podcast channel in order to stay updated on upcoming episodes. Over to you, Adam and Isla.
All right, welcome back to the deep dive. Today we're going deep into something that could be a real game changer in options trading, and that is theta decay.
Oh, yeah. Theta decay. It's a big one.
It is a big one.
Yeah.
And to help us navigate this, we've got some great resources lined up, right? Articles from Environmental Trading Edge. We've got Insider Finance Wire, some practical guides on options trading strategies, and we've even got some really interesting analysis from Next Edge Capital. You know, one of the things that I hear a lot, especially from traders who are, just kind of getting started with options, is they get so frustrated.
Right.
Because they'll make what they think is a really good directional bet, and the stock moves the way they want it to, but they still lose money on the option.
Yeah, yeah. And theta is often the culprit there.
Exactly, and that's what we're going to unpack today. Like, how can you not only understand theta decay, but also use it to your advantage?
So theta decay really boils down to this. It's the rate at which an option loses its value over time. Every single day, it's like a little tiny piece of that option's value is kind of melting away. Like, think of it like an ice cube, right?
Yeah.
You leave it out on the counter, it's going to slowly melt. An option, it's the same. As it gets closer and closer to that expiration date, it's losing value. And that rate of loss, that is theta decay.
Okay, so I'm buying an option. I'm basically buying time. And as that time runs out, the option's worth less, even if I'm right about the direction of the stock.
Yeah, you got it. Time is literally money in the options world. But in this case, it's working against you if you're an option buyer.
Working against you. Got it. So let's
Yeah.
make this a little bit more concrete. An example of a 1-month call option on the S&P 500 index.
Okay.
What happens as we get closer and closer to that expiration date?
Well, let's imagine the market stays flat. Like, the S&P 500 just doesn't really move much. Every day that passes, that option is going to lose a little bit of value due to theta. It's like a countdown timer is ticking away.
Okay.
Now, you might not notice it much at the beginning, but that decay really starts to accelerate as you get closer to the expiration date, especially in that last week.
So it's not like it's a constant, just like a steady drip, drip, drip. It actually like speeds up as it gets closer to the end.
Exactly. It's not linear decay. It's more like, think of it like a snowball rolling downhill.
Okay.
It starts slow, but then it gains momentum and it gets faster and faster. So by the time it gets to the bottom of the hill, in this case, the expiration date, it's moving pretty fast.
Oh, that's a great analogy. I like that. Okay. Now, I have to ask this because, everybody's always wondering,
Yeah.
what about the weekend?
That is a really common question. People think, oh, the market's closed, everything's on pause. But the reality is the market is always forward-looking.
Okay.
So when the market closes on Friday, those closing prices, they already factor in that anticipated decay over the weekend.
Oh, so it's not like there's this surprise like, oh, theta decayed all weekend. Now the price is going to drop on Monday.
Nope. It's already baked in. It's smarter to think about theta decay in terms of trading days rather than calendar days.
Trading days. Okay. Interesting. So it's like, we kind of alluded to this earlier. Theta decay, it's constant. It's always there.
It's relentless.
But it's not linear. And that's a big mistake that a lot of new traders, I think, make is they assume that it's just like this steady decline. So we've established that theta decay is always lurking in the background. It speeds up as expiration gets closer. But why should the average listener care about this? Like, how does this actually affect me as a trader?
That's the million-dollar question, right? It's one thing to know what theta decay is. It's another to understand how it impacts your trading. And the thing is, theta decay can be both an opportunity and a risk.
Oh, so it's a double-edged sword. Interesting.
It is. Now, if you're buying options, theta decay is generally working against you. Every day that goes by, you're losing a little bit of that option's value. It's like a race against time to see if the price move in your favor happens fast enough to offset that decay.
So it's like time is literally money for the option buyer.
Yeah, it's constantly ticking away, eating into their potential profit.
Eating into their profit. Okay, so as a new options trader, is it safer to stick to just buying options? Because then you're not going to get hit by that theta decay.
Well, not necessarily. It's not about safer or not. It's really about understanding what your goals are and how you want to approach the market. For some traders, selling options might actually be more suitable because here's the thing. For an option seller, theta decay can actually be a source of profit.
Whoa, hold on. So instead of being afraid of theta decay as an option seller, you can actually use it to make money.
That's the key takeaway here. You're essentially on the other side of the trade. Instead of hoping the option value goes up, you're hoping it decays, and you get to keep that premium. And there are specific strategies designed to take advantage of this, like selling covered calls or cash-secured puts.
Okay, so we're talking about completely flipping the script here.
Right. Exactly. And that's one of the most powerful aspects of understanding theta. It's not just about predicting which way the market will move. It's also about understanding how time decay affects your positions and using that to your advantage.
Okay, so you can play the time game as opposed to just the direction game.
You got it.
So even if your directional bet is a little off, even if the stock doesn't go down as much as you thought, you can still potentially make money from the time decay.
That's right.
Okay, now, my head is spinning a little bit, but in a good way. We've covered a lot of ground just in this first part of our deep dive on theta decay. So just to recap, we've learned that it's a constant force, it accelerates as expiration gets closer, and it can be both a friend and foe to options traders, depending on whether you're buying or selling options. But I'm really curious to get into the nitty-gritty. Like, how do you actually put this knowledge into practice?
That's where the real fun begins.
Yeah, what are the specific strategies that can help you harness theta decay and make it work for you?
Yeah, let's dive into some specific strategies where theta decay can really be your secret weapon.
Okay, I like it. Secret weapon. So let's start with selling covered calls. This seems to be like one of the more popular strategies out there, especially for investors who already own shares of stock.
Right. It's a classic.
Yeah.
And it's great if you think a stock price is going to, maybe stay flat or even rise just a little bit.
Okay, so instead of just holding on to that stock, you sell a call option on those shares. But how does that tie into theta decay?
So here's the beauty of it. When you sell that covered call, you receive a premium, right? That's cash in your pocket right away. And as time passes, that premium starts to decay. It loses value. And the closer we get to the expiration date, the faster that decay happens.
Got it. So even if the stock price doesn't move a whole lot, you're still making money from that premium decay.
You got it. You're basically getting paid for the passage of time. And if the stock price stays below the strike price that you sold, you get to keep all of that premium. Plus, you still own the shares.
Oh, that's pretty cool. So you're basically using theta decay to generate some extra income on stocks that you already own.
Exactly. It's like giving your portfolio a little boost.
I like it. Now, what about selling cash-secured puts? Our practical guide had a whole section on this.
Yeah, that's another really powerful strategy for leveraging theta decay. With a cash secured put, you're essentially saying, hey, I'm willing to buy this stock at a certain price. And in fact, I'm so willing, I'm going to get paid a premium for that commitment.
So you're basically getting paid to potentially buy a stock that you're already interested in.
That's the idea. Now, if the stock price stays above the strike price of the put that you sold by the expiration date, guess what? That option expires worthless, and you get to keep all that premium you collected.
Wait a minute. So you're telling me that I can get paid to potentially buy a stock at a discount, and even if the stock doesn't drop, I still make money?
Exactly. Theta decay is your friend in this scenario. It's slowly chipping away at the value of that put option, and as long as the stock price cooperates, you come out ahead.
That's pretty amazing. So those are like two, kind of foundational theta strategies, but we've also got some more, maybe complex ones for traders who are a little more experienced.
Right. For those who are ready to step up their theta game.
Exactly. Like iron condors.
Ah, yes, the iron condor. Next, Edge Capital, they highlighted this strategy as a really popular risk-managed approach.
Now, I'll be honest, the first time I heard the term iron condor, it sounded kind of intimidating.
I know, it sounds a little scary, right? But it's actually a really cool strategy, and it's designed to profit if the underlying asset's price stays within a specific range. You're basically making a bet that the market's going to be relatively calm.
Okay, so you're not trying to predict a big move in either direction. You're just saying like, hey, stay within this range.
Exactly. Now, to set up an iron condor, you actually sell both a call spread and a put spread at different strike prices. This creates a defined profit range, like a little box where you want the price to stay.
Oh, okay, so it's almost like you're building a fence around the price.
Yeah, that's a good way to think about it. And here's where theta decay comes in. As time goes by, the value of all four of those options in your iron condor, they start to erode. They start to melt away.
Right, because theta's always working.
Always working. And if the price stays within that range that you defined, you get to keep the premium. You benefit from that time decay.
So even if the price moves a little bit, as long as it stays within your fence, you're winning.
Exactly.
Yeah.
The iron condor is a beautiful example of how you can strategically use theta decay to your advantage while also managing your risk.
Okay, that's pretty clever.
Yeah.
Now, we also briefly mentioned short strangles earlier. Those seem a little bit riskier, though.
They are. Short strangles, they're kind of like the iron condor's more aggressive cousin.
Okay.
You're still selling both a call and a put option, but the strike prices are further away from the current market price. So you've got a wider profit range.
Okay, so more potential for profit, but also, I'm assuming, more potential for loss.
You got it. It's higher risk, higher reward. And of course, theta decay still plays a key role. As time passes, those options you sold, they lose value, and that's how you profit.
But if the price breaks out of that wider range, you're in trouble.
Yeah, that's the risk. You're basically betting that the market's going to stay relatively calm. If it takes a big swing in either direction, you could be facing some significant losses.
Got it. Okay, so short strangles, not for the faint of heart.
Not for the faint of heart.
Okay, and then we've also got calendar spreads. Now, these seem a little more nuanced. It's like you're playing with the different speeds of theta decay.
Yeah, you're really getting into the intricacies of theta with calendar spreads.
Hmm.
So the idea here is you're selling a shorter term option and buying a longer term option, both with the same strike price.
Yeah.
And what it's doing is you're trying to profit from the difference in their decay rates. Because remember, options with shorter expirations, they decay faster.
Right, it's like a race against time.
Exactly.
Yeah.
And you're hoping that the short-term option you sold decays much faster than the long-term option you bought, even if the price of the underlying asset doesn't change all that much.
Okay, so it's a more advanced strategy, but it can be really powerful if you know what you're doing.
Yeah, it takes a good understanding of theta decay and how it affects options with different expirations.
All right. Wow, we've covered a lot of ground here. Covered calls, cash secure puts, iron condors, short strangles, calendar spreads. It's like a whole toolbox of theta decay strategies.
There are a lot of ways to approach it.
There are. But before our listeners run off and start, placing all these trades, what are some of the crucial factors that they need to consider before they jump in? Because theta decay, it's powerful, but it's not magic, right?
Right. It's not a guaranteed win. You really have to understand the forces at play. And one of the biggest ones is implied volatility. Remember, we talked about that earlier.
Right. Higher volatility, higher theta.
Yeah.
So even though you might have theta decay working in your favor, a big price swing could quickly erase those gains.
Exactly. You always have to be mindful of the potential for the market to move against you, even when you're playing the theta game.
Okay, so it's a balancing act. You want to capture that time decay, but you also got to be ready for the price swings that come with it.
Exactly. Now, another important factor is strike price selection. Where you choose to place your strikes, that can really affect how quickly your options decay. Options that are closer to the money, those tend to have higher theta, so they decay faster.
Oh, okay. So it's not just about picking any random strike price. You really got to think about where you expect the price to go and how fast you want those options to decay.
Right. You have to tailor your strategy to your market outlook and your risk tolerance.
And then, of course, we can't forget about expiration date, which we talked about earlier. Shorter-term options, they decay much faster than longer-term options.
Definitely. And that's a key consideration for any theta strategy. Do you want to go for a quick win, potentially higher risk, with a shorter-term option? Or are you more comfortable with a slower, steadier approach with a longer-term option?
Okay, so short-term, it's like you're sprinting.
Mm-hmm.
Long-term, it's more like a marathon.
Yeah, a good analogy. It all depends on your trading style and your risk tolerance.
What I'm hearing is theta decay can be really powerful, but it's not something you can just set and forget. You really got to be actively managing your positions and adjusting your strategy as needed.
Absolutely. Active management is crucial when you're trading theta.
Now, speaking of risks, are there any potential downsides or pitfalls that traders should be aware of?
Oh, definitely. Just like with any trading strategy, there are inherent risks. One of the biggest ones is, the potential for sharp price movements. Theta decay can be great when the market's relatively calm, but if there's a sudden, unexpected price swing, it can wipe out any gains you might have made from time decay.
So it's like you're enjoying this nice, slow drip of profits from theta decay.
Mm-hmm.
And then suddenly a storm comes through and washes it all away.
Yeah, that's a good way to put it. You have to be prepared for those unexpected events.
Okay. And what about like limited profit potential? Is that a risk with some of these theta strategies?
Yeah, with strategies like covered calls, for example, your profit is capped. You're giving up some of that unlimited upside potential in exchange for the more predictable profits that you can get from theta decay.
So it's a trade-off.
It is. And then we also have to talk about margin requirements. Some of these strategies, especially when you're selling options, can have pretty hefty margin requirements.
Right. Margin requirements can tie up a lot of your capital and limit your flexibility.
Exactly. So it's something to be aware of before you start implementing these strategies.
So the bottom line is, theta decay strategies, they can be incredibly powerful, but they're not without risk. You really have to approach them with careful consideration and a solid risk management plan.
Absolutely. It's all about weighing the potential rewards against the potential risks and finding what works best for your individual trading style and risk tolerance.
We've covered a lot of ground in this segment, from specific theta strategies to the importance of things like implied volatility and strike price selection. But before we wrap things up, our friends at Spot Gamma brought up a fascinating point about the weekend theta effect and how some traders are actually using this to their advantage.
It's a really interesting concept.
It is. So can you elaborate on that?
It's all about being a little bit clever and understanding how the market works, over the weekend.
Okay.
So we talked earlier about how the market kind of anticipates and prices in that weekend theta decay.
So it's not like there's this big surprise drop on Monday just because the market was closed.
Exactly. Friday's closing prices, they already factor in what's going to happen over the weekend. And savvy traders, they recognize this. So they'll strategically open or close positions around the weekend to try and capture a little extra theta decay. They're using the weekend to their advantage.
Okay, so how would that work in practice? Like, give me an example.
Sure. Let's say a trader wants to open a theta positive position, something like a credit spread, where they benefit from that time decay. They might do it late on Friday, knowing that the market's already priced in that weekend decay. And then they might close that position early the following week.
Okay.
And by doing that, they can potentially squeeze out a little bit of extra profit from that weekend theta.
So it's almost like a little bonus for understanding how the market works.
Exactly. It's these small edges that can really add up over time.
Okay. That's pretty awesome. All right, so we've debunked the myth of the weekend effect.
Mm-hmm.
We've even seen how it can be used strategically.
Mm-hmm.
But now I want to talk about our listeners. We've given them a lot of information today. What are some practical steps that they can take to actually start incorporating this knowledge into their trading?
Yeah, it's one thing to, understand it in theory, but you got to put it into action, right?
Right.
So one of the most important things is to really pay attention to that theta decay rate, on your positions, especially as you get closer to expiration. Remember, that decay accelerates in those final days.
Don't just set it and forget it.
Yeah.
Really keep an eye on it as that date gets closer. Okay, what else?
Well, another key is to really understand that relationship between implied volatility and theta decay.
Right. Higher volatility generally means higher theta.
Exactly. And that can be good or bad, depending on your position.
Right. So you're riding that wave, right? You want that theta decay to work for you, but you got to be prepared for the volatility.
Exactly. Another good practice is diversification.
Diversification. It always comes back to that, right?
It does, because, you don't want to put all your eggs in one basket. So spread out your risk across different strategies, different underlying assets, different expiration dates. That way, you're not relying on any one trade to, make or break your portfolio.
Okay. And last but not least, I know you're a big proponent of this, the trading journal.
That's your best friend as a trader. It's where you track all your theta-based trades. You see which strategies are performing well, under what market conditions. You analyze your wins and losses.
Okay.
And most importantly, you learn from every single trade that you make.
It's like having your own personal coach.
Exactly. It's going to help you refine your approach and become a much more consistent and profitable trader.
Okay, so that trading journal is crucial. All right, so we've come to the end of our deep dive on theta decay.
Time flies when you're having fun.
It really does. And we've demystified what it is. We've explored all sorts of strategies, from covered calls to iron condors, and even how to use the weekend to your advantage. But most importantly, we've shown you how to think about theta decay, not as something to be feared, but as a potential ally in your options trading journey.
It's all about understanding that time is a factor, just like price. And by recognizing how theta decay works and learning to use it strategically, you can dramatically improve your trading.
Absolutely. So to all of our listeners out there, as you continue on your options trading journey, ask yourselves, how can you incorporate an understanding of theta decay into your trading strategies?
Yeah.
The answer to that question might just unlock a whole new level of success. And remember, time waits for no trader.
And that concludes our podcast on theta decay. Thank you, Adam and Isla. If you enjoyed the podcast and found the content helpful, then please like and subscribe to this channel. And if you are on X, the platform formerly known as Twitter, then please follow us. Our handle is the @ symbol followed by selling, the number 4, premium. Thanks for listening.